good afternoon, good evening, and I trust every one of us we are doing well and we're also in good shape. Thanks to everyone that I was able to get the last session activity done and submitted within the expected time. Here we are again today, and let's continue from where we stopped. But before we do that, let me ask us if you have any question or clarification regarding our last task. I think you can let's make use of the chat box. You can just type in the chat box if you have any question, clarification, and also observations. Right. I noticed something from the submission we got. I think um some people decide to go with percent of maybe a particular line item, for example, prepaid expenses as percent of our SG and H, right? Yeah, you can have like a good mix of a thing, but most times, at least based on the experience that we've had, one is it's all about consistency, right? So a if you decide to go with a percent approach, yeah, that can be fine, but most times, because when it gets to a presentation concept, right? I've realized over time, especially when it's networking capital, you hardly get to see people presenting networking capital as kind of a percent of revenue. Most times the story is always based on expected on this, right? But if you decide to go with the percent approach, that is fine. It's not as if it is wrong either. But most times it's always good to just use one particular approach. If you're going with percent, use it across, right? And then maybe your presentation kind of show the trend over time and the whole thing just to tell the story. So starting with percent, just stick with the percents across all the network capital line item. And if you are using days, just stick with days approach. Right. So any question? Any question? Any question? So if you have any question, you can just type that in the chat box or clarification as well. Before we go on, which what we'll be covering today. All right, so while you're still typing, let's get straight into what we'll be doing today. And let's go ahead with our property, plants, and equipment. So we've covered our cash and cash equivalent. Then we have our receivables. We've covered that. We've also covered our interest. Okay, when preparing the schedule, does the order in which you had the line item matters? Okay, yeah. So okay. So a question saying when preparing schedules, does the order in which you had the line item matter? So you are you are free to use your approach, right? Uh, but most time it's always good that you uh just just make it like as if you are reading a book, right? You know the way you have that chapter and sequence. Just try to make it like that so that someone reviewing can say, oh, first thing I'm saying here is calculation. Oh, I'm saying cash, I'm saying receivables, and just like the way you have it in the line item in your financial statement. So it kind of make it easy for anyone going through the model to follow through, right? And also so that you don't miss out any line item. Yeah, it's always very important. Okay, so we need to go to our property, plant, and equipment, right? So let me come straight to my input. Let me come straight to my input. The next one will be our what? So the next line item is property, plant, and equipment. Okay. And what are the things that we are going to need? Firstly, we're going to need our capex, right? we're going to need our capital expenditure, right? So maybe we can write it fully. So capital expenditure. Okay. So let's look at the historically. Um, so I'm going to call this historical expenditure, historical capex. So let's call that out. I think we have a model currency. So I'm going to do this. I'm going to call that out from our historical financial statements under cash flow statements. So payments for property, plant, and equipment. Yes. So I'm calling this out directly from my cash flow statement. All right. Then now let's look at our capex as a percent of our revenue. So I can call this capital expenditure as percent. Let me see. So capital expenditure as percent of revenue. Now, just to make that clear, that one is we can use anything as a driver to our revenue, right? However, we have different approach that we use when it comes to this. And please, I want you to pay attention to this. So firstly is this. So because we have historical capex, let's look at what the percent is to revenue. So historical capex divided by my can even do it from the way really. Okay, so let's do it from our let's do it directly to bring that in. So they will be equal to come to my historical financials, and that will be my payment for property, plant, and equipment under my cash flow from investing divided by my total revenue, and that should give me like a particular percent, right? Yes. So not sure why percent is showing like this. But let me copy this format. Okay. So this is what we have, and I think if you look at what the average is, the average is around 2.4 for the capex. Okay, so can build 2.4, so minus 2.4%, so that we can use that going forward. There are some things that kind of also call your attention to check why we have something like that. For example, in 2020, we can see what we have there. Can see what we have, right? 2020, 1.8, why 2023 also kind of decreased significantly, right? Then the question we need to ask, we just need to check what really happened in that period. Is it more like an interval kind of thing? Was there a particular uh, innovation they had? Do we also expect something like that going forward? Because this kind of affects the valuation, the free cash flow to the business, right? And most times when you are building typical corporate model, you need to give a lot of attention to things that drive that drive our free cash flow, our free cash flow element. Okay. Now, so these are capex as percent of our revenue, right? And the other thing, I think, have we done our depreciation? Okay, yeah. So we also need we need our depreciation, right? We also need to get our depreciation element. We need to get our depreciation. So let me also check. Do we have depreciation split into PPE depreciation and the rest? So let me check. Under our depreciation breakdown, do we have something like that? So let's check depreciation and amortization. Do we have the breakdown? And because you definitely need to check that and to be sure. And well, let's look at the balance sheet first. So the balance sheet, they only have, so okay, so proper, let's say PPE, depreciation, then operating lease and finance lease. So let me ask you guys, does this come with amortization or not? Do you think operating lease and finance lease will come with an amortization? Let me hear your thoughts. Just type in the chat box. What do you think? So I'm actually, so because one is this, if you even if you check their financial statements, let me see. So let's check the financial statements. I think we downloaded their financial statement the other session. Is it? Is it? Is it? So let's check if there is that. Let me see. Let's check. So if we have information, right? I mean, if there's a separation between the depreciation and amortization, we can check that and recategorize what belongs to the depreciation and also the amortization. Let me check. Just trying to look through their financial statements. Let's see. So do we have notes? So let's check. For some report financial statements, you definitely see the division. Okay, so thank you. So on the leases part, so operating lease, so definitely sure there will be anything on that one. Amortization of right of use assets, then interest on lease obligation. Okay, so let's check that as well. Is there any other information? So which reports are we using? So let me check the one for 2023. Okay. Okay. So within corporate model can be stressful at times because you're looking for what is not. But yeah, it's part of it. So let's check. Okay, so 2020, let me be sure this is the same with our model. Okay, yeah, so this is the financial statements. All right, so let me check. Do we have information? So most time when you try to get the information and really can't get it directly from their annual reports, it's just you just have to move on, you know. Well, let's still check. Okay, so finance list, amortization on right of use assets. Do we have any other information? Okay, I don't think so. So I guess just going to pull this. So amortization of right of use assets. Let me copy, put that in here. I'll call this my, so maybe depreciation element or depreciation and amortization. Right, so then we have our depreciation, which will go to PPE. Then we have our amortization, which will go to our right of use assets. Okay, so for 2023, that should be 596. 2022, 565. Here, 583. I think I'm good with it. That should be on the amortization. Then our depreciation. Let me see that we have here already in our cash flow statement. I'll just bring that below here. Then what I'll do is I'll subtract this. I'll subtract it. Yeah, then add both of them together. So what we have as our total depreciation and amortization. Okay, so always good to check with the total that we have in the cash flow. Yes, so value in cash flow. So which means we've been able to do the separation. Please, any question? Any question? Any question? Okay. Guess no question, right? Then let's move to the next thing. All right, so now let's depreciation as percent of revenue. So depreciation as percent of our revenue. Just copy this format below here. So we are sure that yes, we are using the actual depreciation for PPE. Right. So expect this to be in negative. So what we'll do is let's try then put this in negative because it's an expense. Let's multiply by -1. Okay. Yeah, so that's a negative. Then let's look at the last 3 years. So 1.7 on the average. So -1.7 on the average. Please, if you have any question, please ask. I think this is the two things we need, right? We also have some other approach that we use. So I think we have an approach where we use PPE, ending balance, right, as percent to revenue. So I think we call that uh, we call it something asset turnover. I hope I'm correct, right? Yeah, I think it's asset turnover. Guys, I hope I'm correct. I think it's asset turnover, right? Yeah. So looking at what the multiple, it's more like a multiple of your assets to your sales. Then you now do like a a walk back to get your capex. Then there's another approach to where uh we use the balance sheet shape, right? So we look at historically what's the percent of their PPE to their total assets, and we just use that. I think we are still going to use more like that blend approach here, by the way. So now that I have this, I can now go back straight to my balance sheet under my PPE schedule. So where's our PPE schedule? Right, okay, yeah. So I can do like call up. So let me call up this. So equal to, go to my inputs, capex. Let me just call it, let me just put it. So capital expenditure, then the depreciation on PPE. Right, and I can do a call up from my inputs. This is my call up from my inputs. Okay, so our addition, let me rename my table. So our addition is capital expenditure, or subtraction is our what? Depreciation. Okay, so now our capital expenditure as a percent of our revenue. I think we've caught up revenue somewhere in our previous calculation in our receivables. Which is revenue. Okay, but it's always good you do like a call up close to each other. So let's call up the revenue directly from our financial statements. Okay, so call up my sales, copy, then paste as formula. We have this, right? So this is always good, at least for quick formula review. So our capital expenditure, we need to state that equal to, I'm not sure why do we really even need to call up the historical. So let me just put like a flag here. So equal to, so this multiplied by, I was trying to, should we have line item for disposer? I'm not sure. So most times when we build model, we don't usually model disposer, right? Because one is it's more like a management decision thing. It's not something you can model, right? And if you look at the cash flow, why, yes, we have proceed from disposal of PPE, right? Proceed from disposal of certain operations. Oh, okay. So I think this 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 is an error. I think someone noted this error, right? So let me check and what's happening here. Okay, I think we updated the formula. Didn't we? Wait a minute, sorry guys. I remember we updated the formula for balance sheets. Okay, I think we didn't update for cash flow, right? I think if we do that, so I said we should remove this unique ID and just use the line item directly. right? I think I forgot to update this from my own end. So I think by the time I do this, that should correct that. Okay, yeah. I should correct that error. Okay, I think this because of the unique formula there. All right. Then I can remove this unique ID. Oh, okay. So back to the disposal. I think that should sort this. That should update automatically. Yep. I think that maybe that's the reason why we had difference in our cash flow. Is that why? Okay, we'll come back to that by the way. All right. Okay, so yeah, so should we have a line for disposal? Even though in the cash flow it seems they have disposal of assets, right? So proceed from disposal of property, plant, and equipment, proceed from disposal of certain operations. Well, well. Do we think this is a predictable line item? If we think so, we can add it because it seems they've actually been having proceeds from disposal of PP historically, right? Okay, so Musa is saying, assuming the company has a plan to acquire more PPE, how do we incorporate them? By now, I'm sure you should be able to think through that, right? You should be able to think through that. So what we do is, which is a very good point. So let's create something. So we call it disposal of assets, disposal of assets, disposal of assets. Then we call this other one. No, okay, let us come down there. We call this, which is to address that question of PPE. Then maybe maybe management expected capex, right? So this will be in USD, and this will also be in USD, and we can put that here. So that just give them room for this. I think for the disposal of the asset of the PPE, right? Historically, let's see what's the value. So disposal of PPE, right? So disposal of PPE. So we think we're going to have that. So maybe just keep the last value. Or what's the average? But the truth is, it's more like a management line item. It's not something you can use average of something. So you can decide to use that. If maybe the expects additional capex, then we can include that. So maybe by the time we go to the usually have like investors reports, investors presentation and deal thing, and you realize they stated that. So maybe by this period, because they want to introduce a new product or something like that, they'll be incurring particular cost and all those things. Exactly. So you can have those value in addition to what we had already. Okay. Hope that answer our question, right? So please, it's always good you ask a question. Why not come? Right, so let me link that. Let me link this line item. Yes, let me link this here. Okay, so the next one, which is the management expected capex. So we'll link that. If there's anything, then also for the disposal. So here we then need to add uh disposal. Are we meant to add the disposal, deduct the disposal? I think we're supposed to deduct it. Are we meant to deduct or add it? Let me hear from you guys. What do you guys think? So these my assumptions. I only need the forecast. So multiply by open the bracket, then to my period count as long as it is greater than 0. So just give us this. Yeah. Okay. I think I agree with you guys. No, I don't think I agree with you guys. I'm going to deduct it. Then let's copy the same thing. So I only need the one during the forecast period, right? Okay, this should be all right. So for our capex, then our capex will be equal to my capex multiplied by what? Multiplied by my sales. Multiplied by my sales. Then I'll need to put both of them in brackets. Okay, then plus the management's expected capex. That's input, and that will automatically flow in like this, right? For our depreciation, so my model is already shouting, right? Because this needs to go. So the capex automatically flow into the cash flow, right? We'll see me. So this is supposed to be in positive value and not negative. So I need to always make sure. Just let me use my absolute formula so that at every time it stays as positive, right? Even plus, I think everything plus the input, so it must always be positive. So that's what the absolute formula will do. Then this flow in straight into my balance sheet, right? My balance sheet is not balanced currently now. Then I need to link this to my cash flow. So it'll come into my cash flow as negative, right? Okay, so why is it not balanced? Okay. I think I know why it's not balanced. So for our cash flow, what's the link in our cash flow? Let me see that. What's the line item link in our cash flow? So equal to cash flow, that will be payments of property and equipment. Okay, now, so that's supposed to come into this column. Okay, so all this is good. You know your model, right? It can be interesting at times. Wow. Yep. And as I said, see, this method is not compulsory. If you prefer to do the linking thing, right? It's just that to avoid all those error of linking, especially when you are dealing with a with multiple calculation and the whole thing. All right, then let's go straight to our depreciation. Let's go to our depreciation. So depreciation is also the same thing. So my depreciation as a percent of my what? Of my revenue. Now for that depreciation can be funny at times, and I know there's this school of thought that don't agree with you using depreciation as percent of revenue. Now, all the line item can be used as percent of revenue. But for typical depreciation, so because you've incurred the expense in year one, right? Recognize it as a cash capex. And what you are doing is you are just trying to spread that capex in your income statement over a period. So which means even if sales drop, if sales increased, you've already made that provision that these assets will be depreciated over 5 years. So it does not mean that because revenue drop in year 3, that means my depreciation will also drop. No, because it's an expense you've already incurred and you are just spreading it over a period. So there's some school of thought that are saying no, don't use depreciation as percent of revenue. Instead, use it as a percent of previous period PPE balance. Use it as a percent of previous PPE balance, which is what we might end up doing. So So let me remove this. So as I said, if you decide to use it in this approach, right, it is okay, it is acceptable. But as I said, just understanding the analysis, the explanation I gave to you, right, that depreciation really has no uh, direct impact on revenue per se, because you've incurred the capex like in year one, and what you are doing is you are just trying to spread that expenses in your income statement over a particular period. So based on that, right, as I said, yeah, accountant is saying, you know what, we're going to depreciate this asset over 5 years. So which means uh year one, year two, just like let's assume a constant value. So which means even if revenue drop, if revenue decrease, it really has no direct impact as such. So let's use it as percent of previous PPE balance. I hope that makes sense. I hope that makes sense. I hope that makes sense. Right? As I said, yes, we still decide to go with percent of revenue. It's still accepted. We use it at times like that, right? So which means the first period, nothing. So come to 2020. So I'll come to my PPE, my historical. So that means my depreciation in 2020, right? Divided by my what? Divided by my PPE schedule of 2019, which is the previous period ending balance. In fact, okay, we can even do from year one. Yep. So this just kind of give us, so most times this give us more like a closer uh trend, let's say, because it really has no direct connection to the revenue per se. So most times we always decide that, let me do that again. So we are saying equal to, so my depreciation in 2019 divided by my what? My PPE ending balance in the previous period, which is 2019, right? Okay, beginning balance equal to opening balance. Then we have this, and you can see it's easy to capture the average. Even though, yeah, it seems to be increasing. So let's use 11 points. Let's just use the last value, 11.2%. I even think we've been using the same. Okay, we use average for some line item. All right, so let's still keep it like that. Okay, so which means if I come back to my balance sheet, I'll need to calculate my what? My depreciation, right? I'm not sure. Do we need any schedule for 20? Okay. All right. So which means our depreciation will then be equal to the previous period ending balance multiplied by what? Multiplied by our depreciation rate. And copy that across. Let me just call this depreciation rate. Capital expenditure, percent, PPE percent. This, if you have any question regarding my explanation, please let us know. Now, my balance sheet is not balanced, and I'm sure you know why, right? Let me ask you that. Do you know why? Do we know why? Do we know why my depreciation is not, my balance sheet is not balanced after calculating that depreciation? Right? We need the depreciation. So we need to link the depreciation. We've not linked to our P and L. Okay. So first, let me see. Are we sure? So what goes to our P and L? Then our depreciation here. So I can just, let me just introduce that here. I think we can create that here. Call this depreciation. So depreciation and amortization. Okay. All right. Then let me see this. So we also need we need to call up the historical depreciation. Well, let's see. So we just call this historical depreciation. Then we have the forecast depreciation. Right. Okay. Okay. We'll make sure we created the formula is speaking from here. So okay, yeah. So we definitely need to do this. Then this will give us the total depreciation and amortization. Historical depreciation and amortization. Forecast depreciation and amortization. Okay. Here we just make this our depreciation. Okay, so for the historical, so equal to, I think I can just call that up directly from the historical value. So the total, we need the total. We don't expect that to come in the forecast. Then for this, equal to, we link that straight to the balance sheet. So the first one is, see this? Okay, yes. So let's call that from our schedule here. Right. So this come in and we just sum both of them together. So do not expect that to balance now. Right. Then we need to also add it again. So which will be the second one. Okay. If we're going to have 2. Okay, so yeah, so this is supposed to be for this one, why this one will be for this one. So we are deducting, then we are adding back, then this become positive. Will come straight to my, so that should come in, yes. So one is we are deducting it from here, right? And we are, so we are adding it back here and we are deducting it from here. Yep. Okay. Then we now need it to flow into our what? Into our cash flow as well. So let me see. We'll go straight into our cash flow. We'll go straight into our cash flow statement. So 2 things. Then we need the depreciation as well to go equal to, but now to go in as positive value because we are adding it back. Right? So if I go to my cash flow, where is the depreciation coming from? Okay, yes. So the one for the forecast. Okay, why is it not picking it? This depreciation, yes. So why is it not picking it up from our balance sheet? Okay, I've not linked the name column, and my balance sheet should balance back. Do we understand? Any question? Any question? Any question? Are you guys wondering how this whole thing seems to be balancing? Let me hear from you guys. Is anyone confused in the session as to how things just seems to be working fine and connect somehow? Let me hear from you guys. So as I said, see, building model is way beyond artistical thing, right? Of course, it's like you're an architect, right? You're trying to draw house. You can visualize it. You know how everything flows, everything connects together and stuff like that. Can be quite interesting, but Yeah, it's expected. It's expected. I think it was quite easy for me when I was introduced to this style, to this approach. As I said, if you still prefer to go with your direct linking, yes, that's fine. Know where to link to the words, and because it's almost still the same thing. The way I would have linked this to this like a direct link, right? But they just bring that more flexibility into it. Okay, so the next thing is I need to bring in my disposer, right? Okay, so this seems quite complex. Yes, it's complex. So it's not complex, by the way, because everything you are using is just some use. So clients understand. Yeah, I know for some people that at least in typical developing countries, right, it can be hard, but for in a developed country, right, you beat something like this, they your clients are not novice. And secondly, the objective is not for the client to to yes, the client can understand the flow and the thing, but it's not their own headache to understand how the approach you've used in doing that calculation, right? One is they are more they need the output. They are more interested in the output, and if they decide to go straight into the workings, we've actually not done any we've not done any magical workings, to be candid. So let me try and collapse this, right? So let me assume I'm like a typical client. What will the client see? Because that's the question. So when you're saying something is complex, you also need to ask yourself, what what is the client saying? So for example, I send this to them, right? They are looking through the balance sheet. The only thing they can see here is some ifs. So at least an average client, as I said, yeah, not like a country where you see a CFO that does not even know how to use Excel, does not even understand the accounting itself. Those are not the kind of clients we are talking about. I know, yeah, at times you might have to face some clients like that, but some kind of disengagement. Trust me, can't see even typical manager that will not understand what sum is doing, right? So they can see the figures. Then if they want to see the calculation, and that's why I said most times it's always good with this sequential arrangement. Their main headache will be to come in here. They can see the schedule. For example, they want to review how you've go through how you've done your receivables, right? Their main headache is they can see what you have here. They can see your beginning balance. They can see, they understand this is revenue. They can see where revenue is coming from. They can see the cash received, the simple calculation you've done. So you can see that we've actually not done anything magical. It's just the linking method and approach that we've decided to do what? To change. And they can see the ending balance. You've actually not done any magical thing here, right? They can see, oh, this is receivable call up. And that's why I said the breakdown is very, very key. They can see days in a period. They can see receivable ending balance and how you've calculated it. That's their own main key headache. The reason why we're going through that stress is just because of that link, and they can see, oh, financial statement link, balance sheet link, right? Oh, that means they link this to the balance sheet. Cash flow, oh, that means they link these changes to cash flow. Simple. So don't see it as it's not complex. That's not client's headache, right? If they see the outputs and they want to see, oh, where is this output coming from? They see inventories, right? Highest thing they come down to this calculation. So that's why you can see we are using that approach such that everything calculation balance sheets is in that same worksheet. They have this at the high level. We are still going to have like outputs where we have this main summarized financial statement output, which they need. So most times it's not their own headache with this calculation. If not, they would have built it themselves, right? So that's why keep the calculation simple as and if you look at the model, if you look through my formula, I've actually not used any magical formula. The main formula we've been using, some ifs, and I think we use index somewhere. Simple. Right. So even which means you as a modeler, some ifs you see, the magic some ifs can do. You cannot imagine, right? So we've actually not done anything technical per se, right? That an average manager, CFO, a finance person should not understand. Okay. And if you have some experience with some funny clients, you can let us know, and maybe we say, okay, well, maybe you might not need to do it like this. You might need to do it like this. So as I said, that I've had a case where we built it like this, right? And then we send it to our review team. Our review team has to pull it back. And they told us to do what? That we should not use this sum if, that we should just go back and link everything directly. So that's why I said it's not like it's a must thing, but it's always good you have different understanding, different method that we use, right? And see, this kind of make work easier for you. Even if I decide that, you know what, I want to do like a relinking, because when we had the all up and down thing, we had to do like a relinking. And you know what I had to do? So because it kind of help you to reduce your error of linking instead of linking it one after the other. So what I did, for example, my balance sheet, right? I just did like equal to match to look for this particular line item in the list of my balance sheet link. So in the whole column, right? And I should give me the exact match. So which means this is coming from row 68. So all I need to do is to come here and type equal to P68. And you know what happened? I'm still getting the same value, right? So I hope you guys are getting it. So if I come here, if I scroll down, put this down, which means this is coming from row 86. All I need to do is equal to P86, enter and copy. So it's still the same thing with that sum if is doing for us. So my inventory is coming from row 103 equal to column P103, right? And I can change it from sum if the sum if tends to be looking like a magic kind of thing, right? So I know that this will be P121, right? And that automatically you just update your links, but during your own working process, right? So as to just for you to be able to focus on just doing the calculation, and you don't need to go to the balance sheet link equal to and still waste time doing that. This just make it very, very easy for you. I hope you guys understand it now. I hope you guys understand it now, right? So my property ending PPE ending balance, that's coming from row 144, so equal to P144. Enter, and you see it's still giving you the same value, right? But most times, because that's what I actually had to do when they push back, like it's still the same thing for you guys. You just okay, since that's the way you guys want it. So some people usually prefer that so that they can just click on here and go directly to where it's coming from. I agree with that, right? So when you are done with the model build, it's easy for you to just clear the sum ifs and just use the direct linking if that is if that will be preferred, right? Especially sending it to some clients. Okay, I would have cleared the air. But trust me, your ability to understand this and be able to do all those linking will see. Typically, when I'm doing all this linking and doing, you can spend days on building the model. But once you've done that setup with the sum ifs, you are just focus on doing the calculation. Make sure you put the correct line item where it's supposed to be, and you get to move faster with your model build. All right. So please, any other question? Any other question? Any other question? All right. Now for our operating list and our finance list, this is what we are going to do. As I said, attention to detail, very, very key as well, and understanding some of the concepts. However, see, as much as you need full understanding of accounting, right? Now, look at our operating list and look at our finance list. historically. And also come down here and look at our long-term lease and our long-term finance lease. Right? So if okay, let me color this. So look at this guy. So look at this guy, right? And also look at this guy here. Look at this guy here. So these are more related to, I think that should be IFRS 16, right? So where we have operating leases, then we have finance leases. I think they also have some under current and non-current. Okay, yes, which is this. Now, if you look at this, I think for finance lease, that's 17 million, which is the same 17, approximately same 17 million. Operating lease, right? If you also look at the lease obligation, 14 million, right? Approximately. So this one is 13 million, and so which means there's a direct entry for both of them, right? And that's what we also going to keep it like that, right? So which means we cannot forecast, we cannot get to this guy unless we first sort out these two guys, because that's more like the corresponding entry. So for now, we are going to keep this guy. Let me remove this my yellow color. So which means we need to come back to this. Okay, let me go back to our income statement. So we've completed our depreciation and amortization. So let me remove our working. Let me remove the color yellow. Remove the color yellow so that we know the one that we are left with, right? Time if it's looking to like the gap, we can just use like our outline, right? Data, then go to my outline. So just group them. So I can group my column, right? Then I can just take this. Yeah, so it just kind of look like this. If you don't want to, if the focus is not on historical, you can also try and collapse the historical one. But I think I will leave the last year. Right, so it's just kind of look like this. So maybe you just want to present it and you don't want them to be seeing all those figures and the thing. So it's kind of easier to see those figures like this. And if you don't want to show the historical, you expand it. And the other additional column that you've used, you can just group them like that. Okay. And of course, not everyone has like this kind of big screen. So I left out interest expense, interest income in our income statement. And let's take a look back and also check. Did we create the, okay, we're still going to create the margin later. So for our balance sheet, we'll come back to our list. Let me put that in also the yellow color. All right, so we'll come back to that. Now let's do our goodwill and other assets. Okay, so where's our good? Let me check that. That should be, okay, yes, our goodwill, right? And this we're just going to have changes. So changes. Some call it changes or movements, either way. So changes or movements in goodwill. Okay, wait, we've not completed our PPU. We've not included the disposer. Okay, so the disposer, we're saying we are deducting it. Oh, sorry, that's link. So these are disposer. But we only need this for the forecast period. Don't need the historical one. Right, so model will throw up another error. because we need that line item. So come down here. I'll call this the next cash flow link, and that will be for our what? That will be for the disposal of proceed from disposal of assets. Right, so which we are going to link as positive value, and our balance our model should balance like that. Model should be balanced. Okay, so for the goodwill, just said this will be changes in goodwill, and just put this as a normal. Just like 0, goodwill is goodwill. So always be constant. So here we can highlight these guys so that we still remember that we need to come back to them. So for the goodwill, we just call up the changes. So equal to changes in goodwill. Like that. Here, I'll just remove one of these, then update my, just call this movements or changes either way. Just link that directly here. Okay, so do we have anything for goodwill in our cash flow? Because that must also flow into our cash flow statement. So maybe we can put that as part of other investing activities. I think that will make sense. So we should put this under our other investment activities. Right? We can link that straight to our movement. Simple as that. Then other long-term assets. I'm not sure we have information on what constitutes other long-term assets. But where we have information, let me see if it's something we can check and see what that is, because the value is quite on the high side. Right? So let's see if we can check the notes to see what other assets, what it means. Stable inventory, PPE, leases, goodwill. So we have goodwill, any other thing, investments. Okay. So I'm not sure we have enough information on that, but it seems to be more like other investments that they have. So that might not be predictable. So let's also just have like a changes inputs. So let's have like our changes in movements in other long-term assets. Okay. So we also need the changes. Just call that up from the inputs. Just link that. You can remove one from this and change the name to movements. And you have this, so I think it should also be elements of other investing activity as well. Okay. Yep. So So we've completed goodwill, we've completed our other long-term assets, even though the value remain the same. Okay. So it's getting interesting now. And I think for the next session that we're going to have, right? And I think these ones are should be quite easy for you to work on individually. So accounts payable. So I'm going to call this the one that's meant to be task that you need to work on against the next session. So accounts payables, we already have something for under working capital, so you can replicate that. Accrued liabilities, think you can do that. Accrued income tax. Let me see. Okay, let's leave that out. We can do that together in the session. Then think you can do common stock, right? Excess power. So all this one definitely there will be constants. We've set up retain earnings, so I think we already have that. Then we can do the NCR interest, so that we know that next session we just try to focus on the funding, especially the debt model part. So the set, please, as part of our next session activity, complete your calculation assumptions. Remember, for anything working capital, we are using the last period days. So accrued liabilities, do the same thing. So we should leave income tax. Maybe we'll do that together in this section. Then your debt, leave the debts, and the leases, leave it out. I think leave deferred taxes as well. Then I think redeem, this one will likely also be the same across the forecast. So the common stock, which you expect to be the same. Capital in excess of par accumulated. I know they usually have something like a share buyback, right? So you might need to also do your own bit research. So I think purchase of common stock, yes, which they've been doing over the period. So just do like a self-learning around that, and we can move on from there in our next session. Right? So, do you have any question? Any question? Any clarification before we call it a session? All right. So I thank you, everyone, and thank you for today. And please try and complete your task before the next session. You know the time we have, right? Friday at 7 p.m. And remember, as you're learning, right, you kind of also try to upskill your own self. Do more like a self-learning, right? That's the objective. Of course, it's not like a typical training. I'm sure if it's a training, would have finished before, but no, it's to kind of push you to be able to learn on your own. So yes, I'll share the recording once it's available after the session. Right. So thank you, everyone. And please make sure you enjoy the rest of your weekend and be good. See you in our next session, and bye for now.